Hi everyone and welcome back to the History of, and today we're going to be looking at a place where fortunes are made and lost, a place where trillions of dollars, yes, trillions with a T, is traded every single day. I'm of course talking about the stock market. If you're new to the channel and enjoy the video, don't forget to like and subscribe, and without further ado, let's get into it. When I say Venice, what is it you think of? Canals, architecture, a romantic getaway with your better half? I bet you didn't say money. Strangely enough, one of the first places to have its own version of what may now be considered a stock market was way back in the 1300s in Venice. This time period in Italy was the golden age of banking, and many northern Italians known as the Lombards gradually got into banking, taking over from what at the time was a predominantly Jewish dominated industry. As well as the banks, there were also the money lenders, and these lenders helped to fill in the gaps in the market that the banks couldn't cover. The lenders themselves would meet and trade debt between each other. For example, someone with a low risk, low reward debt might want to switch this debt to another lender to help increase his chances of a higher monetary reward. The lenders would carry around slate tablets with their information about clients, much like we'd use a diary or a planner today. The Italians' newly developed financial concepts then began to spread around Europe, and it's in Bruges, in modern day Belgium, where we see the next big step towards what we now know as the stock exchange. At this time, Bruges was in a very strategically placed location. It was in good proximity to both German and Italian merchants. The people of Bruges began to develop a talent for being intermediaries between these merchants. The brokerage was often carried out by innkeepers, so this was considered a very important job at the time. The most famous of these families was the Van der Beurs. They ran the Terbeurs Inn and had been doing for 5 generations. Merchants and brokers would meet outside the inn, in the square, to discuss brokerage and exchange rates. They would gather information which they could use to gauge the economic situation and state of foreign markets. By 1400, this developed into an organised money market, where at set times exchange rates would be announced for cities such as Barcelona, Paris, Venice and London. It's no coincidence that in 1531 the first purpose-built commodity exchange was called the Bourse in Antwerp. This was named after the Van der Beurs family and was the first exchange to keep physical written records. The next major breakthrough came in 1600 with the founding of the East India Trading Company. The business began as a trading body for English merchants backed by the English government, who would travel far and wide to gather spices, slaves, silk and opium, just to name a few things. These voyages were no simple task, and each voyage presented its own challenges ranging from bad weather to pirates to poor navigation. The financial impact from losing a ship and its valuable cargo was not one that they took lightly. So in order to reduce the risk, they used private investors to pay for the voyages, and they in turn would then get a share of the profits if the trip was successful. Many investors would fund numerous ships so that if something was to happen to one of them, they wouldn't lose all their money. Investors still do this to this day by not investing solely within one company or sector. This is called diversification. The East India Company shaped the way modern businesses work today. They would sell stock in their company and the investor would receive income back via dividends. The selling of shares and monopoly that they had on the market meant that larger fleets could be built, thus increasing the profit investors received. The shares were issued on paper, meaning investors could buy and sell shares from one another, but the lack of a stock exchange meant that they would have to go through the hassle of finding an interested buyer, meeting up, and then carrying out the transaction. Many investors in London took to meeting at coffee shops as well as putting up posters as a way of trying to find interested buyers. People began to take notice of the investors who were making money hand over fist and unsurprisingly wanted a piece of the action for themselves. Because buying and selling shares was a relatively new concept, there was no regulation on it within British law. A new company popped up, and this one was called the South Seas Company. People keen to get in on the hype invested in the new company in the hopes it was going to be as rich and lucrative as the East India Company. SSC hadn't even done one voyage, but were decked out in fancy London offices with all the bells and whistles. More and more of these companies promising vast returns to investors began to appear, and people kept on buying the shares in these companies. Surprise, surprise, the bubble burst and lots of gullible people lost their money. After this, there was an outright government ban on buying shares for years to come. It was 1802 before the London Stock Exchange was to get its first building located at Chapel Court, but just over a decade earlier in 1790, our American cousins across the pond created their own stock exchange based in Philadelphia. However, the New York Stock Exchange, which came a few years later, soon became more prominent and is what we tend to think of today. The New York Stock Exchange first came to being in 1792, when 24 brokers met under a buttonwood tree on Wall Street, and in 1817 adopted the name the New York Stock and Exchange Board. This was later renamed in 1863 to the New York Stock Exchange, which is what we know it as today. Much like stocks themselves, the New York Stock Exchange has had many ups and downs, such as the Panic of 1873, which was a financial crisis that impacted both North America and Europe and led to a 2-decade-long Great Depression. Shortly after this financial crisis, the New York Stock Exchange insisted that companies must disclose their financials if they wanted to sell their stock. This was to help investors make informed decisions and was aimed to be a preventative measure to reduce the chances of something like this happening again. But as we know, history tends to repeat itself, and on October 29th, 1929, on a day now known as Black Tuesday, the Wall Street crash happened, sending shockwaves around the world and would lead to another Great Depression. There wasn't one main reason that the stock market crashed, but a whole plethora of them, including wild speculation of stocks during the Roaring Twenties, unemployment, low wages, as well as high levels of debt. Mix these all together just right and you're left with a damaged economy that would take 10 years to recover. The Dow Jones Index lost over half of its value during this time period. For those of you who don't know what the Dow Jones is, it's an index which tracks the top 30 most traded stocks on the New York Stock Exchange. So by looking at indexes such as the Dow, this gives us a general view of how the stock market is performing overall. Unsurprisingly, World War II didn't help the market either. When Germany first invaded Poland, the market didn't react too badly, but when Paris was taken in 1940, the market took a real beating. Over an 8-day period, the market fell by 23%. It bounced back slightly, but events such as Pearl Harbor saw the Dow fall to its lowest level since 1934. However, once it became clear that the Allies were going to win the war, the market slowly started recovering, which led to the Dow increasing by 130% in 4 years and led to the post-war boom. Despite there being numerous stock markets across America, including the previously mentioned Philadelphia, as well as Chicago and Los Angeles, New York was still the big kahuna. But for how long? In 1971, we saw the introduction of the National Association of Securities Dealers Automated Quotations, or Nasdaq for short. Now this was a game changer at the time because it was an electronic exchange which allowed for stocks to be bought electronically without the need for a physical location. However, when people talk about the Nasdaq, what they're typically referring to is the Nasdaq as an index, similar to the Dow Jones. The Nasdaq typically holds technology companies, so this is where you'd find the likes of Apple, Microsoft or Amazon. However, as it stands today, the New York Stock Exchange has a larger market capitalisation than Nasdaq, London and Tokyo combined. When people think of computers and the stock market, they may think of the 80s or 90s, but the market was actually using computers as early as 1966. Now, these computers were a shadow of what we know today, but they were still in use. But even with all the technology that was available in the 90s and early 2000s, the market faced new challenges. During the 90s, in what's called the dot-com boom, internet-based startup companies began to appear, and fear of missing out hit a lot of investors, who instead of investing in well-established stocks, began to invest in companies that had not yet turned a profit, in the hopes they would soon be worth a fortune. This triggered a snowball effect of people following suit, and by 1999, 39% of all venture capital investments were going to internet companies. The Nasdaq peaked on the 10th of March 2000, and at the end of 2001, most of the dot-com companies went under. By October 2002, the Nasdaq was down over 76%. This wasn't the only crash we've seen in the 21st century. The next one occurred in 2008, this time due to mortgages being offered to individuals with low credit scores who had a high risk of defaulting on loans. These were known as subprime mortgages. The ramifications of these bad lending decisions led to a great worldwide recession. In December, the number of unemployed people increased by 632,000 to 11.1 million, and the unemployment rate rose to 7.2%. Since the start of the recession in 2007, the number of unemployed people grew by 3.6 million. And that brings us to 2020, but unfortunately due to certain regulations in place on YouTube about current events, I can't really go into too many details, but as an investor myself I was keen to cover this topic. If you have ever wanted to try your hand at investing, I've left a couple of links down below in the description for the apps that I use. It's worth adding that I don't have any form of sponsorship with these companies, but if you do register, we do both get a free share worth up to £100 once you've made your first deposit. And as Rockefeller famously said, the way to make money is to buy when blood is running in the streets. Thanks for watching this episode of The History Of. Don't forget to like and subscribe, and maybe drop a little comment down below with any topics you'd like me to cover in the future. As always, thank you for watching, and thanks for being on the right side of history.